Welcome to the Corporate Director Podcast, where we discuss the experiences and ideas behind what's working in corporate board governance in our digital tech-fueled world. Here, you'll discover new insights from corporate leaders and governance researchers with compelling stories about corporate governance, strategy, board culture, risk management, digital transformation, and more.
Hi, everybody, and welcome back to the Corporate Director Podcast, the voice of modern governance. My name is Dottie Schindlinger, Executive Director of the Diligent Institute, and I'm joined once again by my fantabulous co-host, Megan Day, Strategy Leader here at Diligent. Megan, how are you today?
I'm hanging in there, Dottie, just catching up on the news as we are all want to do these days, and saw that the SEC has officially dropped its defense of those climate reporting rules that we were all so jazzed about 2 years ago.
Remember that? Remember how we were all waiting for the rules to drop? We couldn't wait for the rules to drop. Oh, how young and naive we were.
Thing. I remember I watched the whole original announcement.
Yeah, it was a different time. Feels like it was 17 years ago at this point. Very, very different time. Well, listen, Megan, in addition to the SEC finally saying, yeah, not so much with the climate rules. We're just moving on. I got to say, I don't know how you're doing, but we just got the results back from our Director Confidence Index for this quarter. And directors not feeling so good about the state of affairs. We have not seen confidence levels this low ever since we started doing this report 5 years ago. I mean, we started this report back before the pandemic. And even in the midst of the worst part of the pandemic, they were more optimistic than they are feeling right now. It is pretty alarming. Yeah. The actual number plunged 30% from the last time we asked this question. We always ask the question about what is your current confidence in the current conditions and business conditions. It is really at an all-time low. It was, I think it was 4.6 out of 10, which is really low. We also asked, how do you think things are going to be a year from now? And they're not feeling great about that. 41% told us they think that the conditions are going to be worse. 24% think they're going to be unchanged. Only 36% told us they think that conditions are going to improve. And then here's the one that really set me back on my heels. We asked, what's your best forecast for the U.S. economy over the coming 6 months? And a whopping 60% of them said we're headed for a recession. So, Megan, buckle in. What do you think? We're going to go there?
Well, I don't know that I necessarily want to talk about the dreaded R word, but I have to chuckle thinking of all of these headlines that I read, 5 months ago, about how we're going to finally return to the IPO boom and
right?
all of this stuff. And
honestly, it all seemed really possible. Even as late as I would say October, November of last year, we were all kind of on that same wavelength. We're thinking this is going to be the big IPO year. And yeah, not so much. It is just not, no.
Money a-flowing, M&A, going nuts, IPOs left and right. And
well,
hey.
and to that point, Megan, I mean, it also really bears saying, and when we did our What Directors Think report, which we always field that survey at the end of the previous year and then publish the results in January. So the survey was being fielded mostly in October and early November. And, everything was all about growth. We're focused on growth. We've spent the last couple of years focused on cost containment. Now we're all about growth. Well, we asked in this Director Confidence Index, has your growth strategy changed when you're looking at the short term? And 31% said, yeah, we have now pivoted to a more cautious wait-and-see approach. Now, in all fairness, 56% told us, no, we're not letting these fluctuations change our direction. We're sticking with our growth strategy. So that's a good sign. But the fact that, nearly a third are saying, yeah, we're going to kind of just slow down on growth. When you get a third of corporate directors saying we're slowing down on growth and 60% of them think we're headed for a recession, I kind of believe them. So, golly, it's nice to be in spring. I don't know where we go from here, Megan, but
it's always fun
stormy
talking
weather.
uncertainty with a group of people accustomed to uncertainty and no one feeling good about the uncertainty ahead. So
Exactly. Well, listen, one bright spot that we can share with you is we had the opportunity to speak with Kevin Roy, who's the global head of Issuer Solutions at S&P Global, about shareholder engagement. And, it doesn't matter sort of what your strategy is for the year. Engaging with shareholders still needs to be a priority. And he had some just great practical advice to share with people about how to do it well. So why don't we give that interview a listen, and maybe that'll buck everybody up a little bit after our doom and gloom announcements. Joining us on the Corporate Director Podcast today is Kevin Roy, Global Head of Issuer and BigDough Solutions at S&P Global Market Intelligence. Kevin, welcome to the show.
Thank you for having me today.
Well, Kevin, that's quite a title. So listen, I think I would be remiss if I didn't ask you to explain what BigDough Solutions are for those who are uninitiated.
Yes. Well, a funny name. It's a well-known name with regard to a database of institutional investors and the portfolio managers and analysts that both public companies and broker dealers, the sell side, interact with on a daily basis. So they use that data as part of their daily workflow to measure and engage with those stakeholders.
Well, speaking of data, one of the reasons we are excited to have you on the show right now is that you recently published a report called IR as a Competitive Advantage. And I wondered if you could share a little bit of an overview of some of the findings in that report for our audience.
Yeah, I mean, it's interesting in that we actually conducted the study the first time back in 2020. And what we were trying to uncover was whether or not what were kind of deemed best-in-class IR teams resulted in a competitive advantage for public companies. And the way that we defined best in class is we compiled a list of global IR programs that won industry awards from industry publications like IR Magazine and Institutional Investor. And what the results of those studies indicated were that those programs, as measured by both valuation and volatility, achieved higher valuation relative to other companies in their market caps, and also reduce volatility, again, relative to other companies in the same market cap. So the study we updated last year to see kind of post-pandemic what's evolved, and do those kind of benefits still exist?
So, Kevin, I want to dive a little deeper on what you just said, because I know that in the findings of the report, it showed that a lot of things about kind of the fundamentals of investor relations haven't changed, but that since the pandemic, there have been some pretty significant changes. So can you share with us what were some of those big significant changes?
Yeah, it's what's interesting is how much more pronounced the best-in-class programs now trade at a premium valuation and experience lower volatility relative to when we first did the study in 2020. And back in 2020, the best-in-class programs traded at an average premium of 8% and experience a 8% reduction in what we call beta implied volatility. Fast forward to today, and that premium has increased to 34%.
Wow.
And the companies experienced 37% reductions in volatility. So, very immaterial.
Yeah. So what accounts for that? I mean, that is pretty astonishing. What are some of the strategies that those companies are employing that gets them to achieve those results?
So I think there are a few things. There's kind of the tactical aspects of IR, and those are the things that really don't change. And that's how a company thinks about how they engage with investors, how they measure their IR programs, and more recently, how they're integrating AI. We have to say AI, right, in the podcast, to increase effectiveness and efficiency. But some of the other changes that have occurred and have really created a more of a spotlight is, who are the individuals in the role of IR, and how have those individuals upskilled with regard to responding to the changes in the capital markets, and really who those individuals are today versus who they used to be even 10 years ago. So, historically, IR was generally someone who had a communications background or a marketing background. And today, what we're seeing is a lot of both former buy side and sell side analysts moving into the role.
So I know that one of the things that was sort of flagged in the report are some of the qualities that are so important, credibility, trust, responsiveness. Those are things that are really crucial for the success of investor relations. Can you elaborate a little bit a little bit more on why those specific attributes would be so important for companies to help build those relationships with investors?
Yeah, the way I think about that question is through the lens of what we call an active buy side portfolio manager. And an active means that they are making decisions on how they're going to allocate the capital within a fund. And when that portfolio manager is making that decision and they're looking to, buy company A stock versus company's B stock, they're going to look at the quantitative aspects of those companies. What are the fundamentals? Probably very similar. So what the portfolio manager has to do is then start to think about the qualitative. And that's really where IR comes into play. And the portfolio manager is probably going to ask themselves, between the two companies, which one is more credible? Or, how quickly do they respond when I call or email them? And that's important, particularly when there's a lot of volatility, or, maybe there's news that, has some sort of negative impact. And, ultimately they're going to have to make the decision to maintain a position or increase their position to take advantage of the decline in share price. So, and there's another dynamic at play here, and that is the competition that public companies have for, that active capital, where there is an individual who is making that decision. What has happened over the last 10 years is that capital has rotated into more passive strategies. So think about an ETF, that's benchmarked to the S&P 500. And when you look at the total assets under management, passive strategies used to account for about a third of all equity assets under management. Today, that's increased to 50%.
Wow. That's a huge change.
It's massive.
Yeah.
And that trend's not stopping.
Right.
So what it means is, as a public company, the pool of capital that you're trying to attract from the active managers is declining. And, you when you're competing for that capital, have to have an effective IR team that is going to, create that trust and credibility with the portfolio managers.
So one of the things I also thought was pretty interesting in this report is that it talks about ESG as a baseline expectation now, and that AI is kind of seen as a tool to enhance IR effectiveness. So I'd love to hear you reflect a little bit on that. I mean, how are companies integrating ESG and AI these days into their IR strategies? I mean, things have gotten a little topsy-turvy. So
Yeah.
what are you seeing?
Well, the ESG landscape obviously continues to kind of ebb and flow, particularly because of political change, but then, depending on where you are in the world, regulation, and then, whether or not the corporations themselves buy into it. But what I do think will continue is, ESG serving as a tool to measure risk, particularly if you think about environmental and governance. Social, I think is still to be determined. But I think that's what the investment community is using it as. right? To see what potential risks there is, what's material, what's not material. So, I think the story is kind of continuing to evolve. In some respects, with regard to AI and how companies are leveraging it as part of their IR programs, we're at the really beginning stages here. And I think you could say that for pretty much any department. So there are obvious benefits that an IR team can, and how they can leverage AI. That would be an example that would be leveraging AI to analyze large volumes of documents or research reports to understand the trends in an industry or the questions that their peers are being asked during their quarterly earnings calls. And then, the other way that we're talking to clients about integrating AI into their programs, and this actually relates to the partnership that we have with Diligent and the new Market Insights reporting dashboard, is understanding how the buy side is integrating AI into their process. And one of the kind of the biggest areas that the buy side leverages AI is to measure sentiment. So sentiment on the words that are spoken by executives during a quarterly earnings call. And, are the words that they are using positive or negative? What is the, complexity of the language that they use, or the financial transparency? And so giving those teams the tools to understand how it is being perceived by the buy side, so that they can be more proactive in their prepared remarks, but then also learn from the Q&A components of those calls to better answer the questions that they're asked.
I'd love to have you project out the next couple of years. What are some of your, kind of best and final recommendations to IR teams on how they can really enhance their practices, stay competitive, stay effective? Is it all about AI? What are some of the other things that they need to be thinking about?
So I recently had the opportunity to sit down with the CEOs of the associations, the IR associations for the G5 countries. And, much of the conversation focused around some of the challenges that companies are facing because of that dynamic I talked about earlier around the declining size of active managers. And so that was focused on, how do you schedule and engage with the right active managers? But what we also talked about, and relates to kind of some of the findings of the study, was, how do they help drive the upskilling of their members to, ultimately what we call get a seat at the table with the C-suite and the board. And then that, to me, is really important, because if you really want to have a best-in-class IR program, that head of IR needs to be at the table with senior management and the board, be viewed as a strategic decision maker. And to do that, ultimately what that results in is that when the buy side is talking to that head of IR or the IR team, they know that the answers to the questions that they ask are the same as if they were speaking to the CEO, the CFO, or a board member. And that's really, I think should be the focus for any public company, to get that level of seniority in the role.
Seniority and consistency, it sounds like, right? So really just absolute clarity on what the plan is, what the strategy is.
Yes.
Well, Kevin, this has been a really great conversation, but before we let you go, there are 3 questions that we like to ask every guest that joins us on the show. So the first question is, what do you think will be the biggest difference between boardrooms today and 10 years from now?
I think there's 2 answers to that question. One is, for a public board, and one would be for a private board. For public board, I think what we'll see is the average age of a board member is going to continue to decline. You know, partially because of the topic around AI and how you implement technology and just, the complexities of really just understanding how it's going to impact a business. And then on the private side, there's this interesting trend that is happening because of the lack of IPOs that we've seen over the last 5 years, and that is private companies are staying private longer, and some may never go public. And because of that, we're seeing asset managers that historically only invested in public companies are now starting to invest in private companies. And that's going to, I think, have a pretty big impact on how those private companies think about their board. And then, the challenges that exist between, what you're going to share with a private owner, right? Whether you're PE backed, whatever it is, versus now having, kind of public related owners and, the challenges around disclosure. So it'll be an interesting 10 years for sure.
It's a really interesting prediction. I think probably the first time we've had that prediction. So thank you. It's great. I love it. We'll see. We'll talk to you in 10 years.
Right.
Next question is, what was the last thing that you read or watched or listened to that made you think about governance in a new light?
Last December, I was at a conference. The conference was with kind of senior IR professionals, individuals with 10, 15 plus years experience. And one of the sessions was a discussion with a head of engagement at a well-known activist investor. And he asked the audience how many of them had dealt with an activist or feared that they were a target of an activist. And 95% of the room raised their hands.
Wow. That's a big change from years ago.
It is.
Yeah, that's amazing. And finally, Kevin, what is your current passion project?
I should say, well, I guess my answer would be projects. And that is, I have a 14-year-old daughter and a 6-year-old son. So between the two of them and my wife, they kind of keep my perspective in check. But really, it's making sure that I balance work and life in a way that doesn't have one of them overwhelm the other. And I think that's probably a lot of people would say that, just given post-pandemic and the importance of balance. But there are always work things that we're doing, but I think it's important on the balance side.
I love that. Well, Kevin, thank you so much for joining us today on the show. It's been great to speak with you.
Thank you for having me.
We've been joined today by Kevin Roy, Global Head of Issuer and BigDough Solutions at S&P Global Market Intelligence. Kevin, thank you so much for being our guest.
Thank you.
Great interview, Dottie. I don't know if it bucked everybody up, but it certainly had me thinking about just how much change we have seen and will continue to see, and how that flips some professions on its head. I mean, the idea of organizations now having to compete for capital in new ways, the idea of having, public related owners on your board, maybe if you're a private company, that just, it changes so much.
So much has changed. And, it's funny, Megan, when he said that during the interview that, now there's a lot more competition, not just, for capital, but of people who have capital, more competition to get attention from the dwindling number of public companies. I just really hadn't thought about it from the investor side, which sounds really dumb. I can't believe I hadn't, but I just hadn't really thought about it from the investor side. I've always been kind of looking at it from the corporate side, and I thought that was a really interesting comment. I also thought it was kind of interesting to hear him talk about, the way that a lot of companies now sort of approach investor relations as it's not just table stakes. It's one of those things that you need to put a lot of muscle into, and that there's a lot of dividends that pay off from that muscle, that if you just keep exercising that muscle, you keep the IR team strong, you keep the engagement strong. It doesn't matter whether you're at risk of any sort of activism or not. You just need to keep the phone lines open and keep the communication flowing. And I do think to a pretty large extent, that is the way most IR teams and companies approach their work now. But probably wasn't true 10, 15 years ago. I mean, it is amazing how there's kind of a whole field that has just changed in the last 10 or 15 years. And I wonder where it's going to go with AI.
Well, that's everybody's question about everything.
Right.
But I do think if you're interested in this topic, definitely check out our friends over at Diligent Market Intelligence, their annual shareholder activism review. It's a great report that digs into really what investors are thinking about. And again, Dottie, it's an area that we probably don't spend too much time talking about here on the show.
Yeah. And by the way, that is always a great report when it comes out each year. I have not had a chance to read it, Megan. I don't know if you've had a chance to take a look at it, but it is always worth a download and a read. It's always full of very interesting insights from the previous proxy season and can kind of help you understand what you need to be thinking about for the current proxy season. And frankly, anything that helps you figure out what to do this year is probably really good. So given how crazy things are, anything that stood out for you, Megan, in the report?
Well, I think a lot of it was like similar to the conversations we had with the folks over at Wilson Sonsini in a couple episodes back. The idea that, it's just, not to sound like a broken record, it's changing so much. But the number of public companies is getting smaller and the number of activists are rising. And so, even the comments about how everybody raised their hand and said they think they could be at a threat to an activist inside their organization. I think that is like a very real possibility. But the tone in a lot of ways has changed so much that it was 5 years ago even, where people genuinely felt scared by the idea of having an activist engage in their organization. And not that it's like table stakes now, but I think we're at a point where we're able to have a much more open and candid conversation about, what's happening.
And don't you think the 5% that didn't raise their hand are already engaging with an activist?
Yeah.
And that's why they didn't raise their hand. I mean, because honestly, it is just really true. You expect it. And to your point, you're no longer terrified of it. You're no longer terrified of being singled out. There's no being singled out. Everyone's being singled out. It's like everyone's being, called. And so it's just something you've got to be ready for and got to have good conversations. I will say, we always love to ask those 3 questions at the end of the interview. The one that I asked about the difference between boardrooms today and 10 years from now, he said something, I didn't get a chance to push on it, but he's like, I think the average age of board members is going to decline and, really focus a lot around AI and implementation of tech. But I wondered what you think of that, Megan, because haven't you and I been saying that the entire time this show has been on the air? And it's never happened. It has not nudged from 63 and a half years of age in living memory. And I think it's because, and frankly, it does make some sense, you always have a mixture of board members. So you have some that are aging beyond 63.5 years of age, and then you're bringing on 50-plus-year-olds. And so the average doesn't really go down. I wonder what you think about that. I kind of don't think it's going to ever go down. I think you're going to always have this kind of diversified age in the room that's always going to average somewhere around 63 and a half years of age.
Yeah, what we have not spent a lot of time looking at is the average age of private company board members.
Yeah, that's a good point.
I mean, it's I think intrinsically going to be lower because you have a lot of, operating investors on boards, and by nature of people just having day jobs makes them slightly younger in age. Something to think about.
Would really be great to get, more of that data, because of course that's one of the natures of public versus private, right? We don't have as much data on private company boards as we do on public company boards. But yeah, would be definitely interesting to see what that looks like. Well, Megan, that wraps up another episode of the Corporate Director Podcast, the voice of modern governance. I'd like to say a few special thank yous, first and foremost to our S&P Global expert, Kevin Roy, podcast producers, Kira Ciccarelli, Steve Clayton, and Laura Klein. Our sponsors for this show, PwC, KPMG, Wilson Sonsini, and Meridian Compensation Partners. And most especially, thank you to Diligent for continuing to sponsor the show. If you like our show, please be sure to give us a rating on your podcast player of choice. You can also listen to our episodes and see more from the Diligent Institute by going to diligent.com/resources. Thank you so much for listening.
You've been listening to the Corporate Director Podcast. To ensure that you never miss an episode, subscribe to the show in your favorite podcast player. If you'd like to learn more about corporate governance and tools to help directors do their job better, visit www.diligent.com. Thank you so much for listening. Until next time.